What is going on, y'all? Happy Wednesday. We are back at it with another Wealth Wednesday. We are in part 3 now. If you missed last week, we kind of talked about amortization, what it means, how banks make their money, and the 3 big benefits of owning a home versus renting a home, right? This week, we'll be talking about one of the big questions I'm facing right now, Bryson. Should I take advantage of these rates right now? Should I wait for housing prices to come down? I have a very definitive answer on that, but I kind of want to show you, right? I want to show you exactly why interest rates are so much more important for building wealth for you and your family. Low interest rates are so much more important than worrying about depreciation in a very real asset or housing prices to plummet in a very, very real situation on interest rates. So stay tuned. We'll be talking about that. But as you can see right here, we're going over the same example we went over last week. 250,000, 30-year term, 3% interest rate, which is not unreasonable. That's actually high compared to some of the ones I'm seeing right now, which is nuts. I saw one of my clients got quoted a 2.375% interest rate. We'll just see what that looks like real quick. I mean, you're talking about almost 30 grand less in interest paid. You're talking about a monthly payment of less than $30 less than $1,000 for that. That's crazy. So that kind of shows exactly what I'll be talking about today on why interest rates are so much more important for worrying about a home buying decision than the home price itself. And 250,000 is pretty standard here in Jacksonville. That's kind of the average home value these days, depending on your area code. I know here in Mandarin it's closer to like 230, something like that. But we're gonna go back up to our 3%, 250, nice even numbers. And I want you to take a snapshot, right? We're looking at almost 130,000 in total interest paid throughout a 30-year lifespan. Monthly payment of 1,054, and you're paying it off in 30 years, right? Let's take that same 30-year. Let's decrease home prices. Let's just go atomic here. 225,000, right? You're talking about a 10% decrease in home prices, which, I mean, we really haven't seen outside of the Great Recession. We haven't seen that. That is completely unheard of, but we'll say that. But let's say that interest rates rise to 4% and beyond. I mean, if housing prices decrease 10%, guarantee you interest rates are going to go much higher because people might be scammering into the market. That generally will signal some sort of recession. It's going to be a greater risk to lend to people. You are going to see higher rates. I think it is much more likely we will see higher rates than a 10% decrease in home prices, but we'll just do it for the sake of, again, cleaner numbers, right? I want you to see what happens here. Talking about $20 extra in a monthly payment. Doesn't seem like a lot, right? Here's the kicker. You're looking at 32 grand more in total interest paid throughout the entire life of your loan. On top of that, look at the amount of principal you're paying up front. You can see it's far less. You're looking at far more interest payment up front than you are in principal payment at $20 more. So not only are you paying $20 more, but you're also paying way less of your principal balance, which means you have to live in the home way longer to see the same amount of equity build that you did in the last example, right? That's nuts. I mean, that is crazy to me. I would rather have a higher principal balance and a lower interest rate by far, 10 times out of 10. Interest is literally the cost of money. That is how banks make their money. That is how the lenders and investors and the whole mortgage-backed securities market works, is they set the precedent. So I, again, cannot stress this enough. Take advantage of the low rates right now. If this example didn't absolutely encapture it for you, you're paying more in this scenario, $20 more a month. You're paying 32 grand more in interest, which is money you don't see again. And you're paying your principal at a slower rate, which means that if you sell your home, let's say you're there for 5 years, right? The person who has the $250,000 principal balance locked in at a 3% rate, even if housing prices go down lower, is probably going to net more money than you do, right? So I hope this was helpful. Let me know if it wasn't. If you have any questions about this, seriously, this is vital for understanding why now is the time to buy. Please go buy. Now is the time to, if you're looking to expand, this is the time to do it. If you're looking to sell your house, step on up into a home, this is the time to do it. I cannot stress it enough. Now is the time to be buying real estate. It is so vital. It is so incredibly vital for building wealth. Next week, we'll be talking about how real estate is an inflationary hedge and what that means for you and what that means for the future outlook of the real estate market. So stay tuned. This is very valuable information, and I hope you find it of use to you in your home buying decisions, your home selling decisions, your real estate decisions in general. So thank you so much for tuning in. I will see you guys next week.